Hey everyone, this is Ryan Mallory for SharePlanner.com. Today is October 29th, 2015. And with this video today, I want to go over how do you trade an overbought market, because everybody realizes since the beginning of the month or since late September what it is the S&P 500 has done. Since the 29th of September, the S&P has rallied from a low of 1871 all the way up to 2086. So that's 215 points. And we're actually off a little bit today. Not much, but about 3 points or so. But that's a 215 point rally, okay? And it really hasn't pulled back much. You had probably the biggest pullback here back on mid-October here, and really the longest pullback that we've been able to put together is a 2-day pullback, and each time it comes off of the 10-day moving average. We had a 2-day pullback this week, so each week in the past 3 weeks we've had a 2-day pullback, and each time it's bounced off of a moving average and rallied much higher. So here we have the 10-day moving average, and then again on this 10-day moving average, and then this week it was actually the 5-day moving average. So instead of the trend actually getting flatter, it's actually somewhat getting steeper here. I mean, it started looking like we were flattening off here, and we were going to pretty much have a non-eventful month of second half of October. But instead, I mean, we leveled off for a few days, and then we've just blasted higher. So listen, I don't know how high this market can go, and there's nobody out there that does. There's guesses, and you don't ever see any of these guesses that are right. If somebody's making a guess, you can pretty much say that that's not going to be the correct destination for the stock market, because that's usually the case. But you got the S&P 500. It's got a little bit of the 200-day moving average supporting it underneath. That's healthy as well. But we're getting back now into the middle of the range that plagued the market all year long. Essentially from February all the way through the end of August, mid-August, we were stuck in about like a 2 or 3% trading range, and it was one of the tightest trading ranges that we've ever seen in the stock market. So now we're back right into that range. I don't know if the same resistance and support levels are going to hold like they did before, but we got to see. I mean, it very well could. So if it gets back up to like 2134, then there's definitely going to be some resistance at play there. But really, we got through 2080. That was a resistance level. It blew past that yesterday. It's holding it today. So really, for me, the next point of interest on the S&P 500 is going to be this 2134 level. But here's the bigger question: how do you trade an overbought market? Because the market has rallied in epic proportions so far this month. And so a lot of people are going to be judging themselves by, especially if you're a swing trader, you're inclined to look at it as like, okay, we're up, 7-8% for the month of October. Why am I not up that much? You're not, but here's the thing, you're not going to be up that much in October. I'm not up that much, and I'm fine with that. But here's the reason why. You got a market that's selling off. When the FOMC statement came out in mid-September and it rallied down, I was short this market all the way down. So September, despite the market being down, I was up. And then you start seeing signs like this little doji candle here. So you start covering some of your short positions. You don't want to be too short at this point because it's testing lows. It acts like it can't break through it. So I started covering some short positions right around this time. It was forming a double bottom. That was definitely a concern. But am I going to go 100% long all of a sudden at this point when this is the market that's staring me in the face right now? No. Because this could just be a breather before another big leg down. So why would I want to get long on the market right here? So this is what I'm trying to talk about. This is about managing your expectations, especially when you look back over the course of the month and you're saying, why am I not up 8%? Market's up 8%. I'm underperforming the market. Your performance is not measured by how you're doing on just 1 month. Your performance is gauged by how do you do over the course of a year, because over a course of of 365 days in a calendar year, you're going to have a lot of ups, you're going to have a lot of downs. It's not going to be one 45-degree angle higher. We've had some years that are kind of close to that, but typically you're not going to have that, and you're definitely not having that this year. We've had more downs than we have had ups. So when the market rallies here, okay, is this a time to get 100% long? Okay, there's definitely an argument that a double bottom might be forming, and you're definitely wanting to add some long exposure here because that's a pretty strong rally. But I mean, you can't test the pool waters. When you go into a pool, you can't test the waters with both feet, because if you do that, you're going to sink right to the bottom. And it's the same principle of the stock market. You got to build that position up as you gain a little bit more confidence with the market. It's not about being the hero and going 100% long UPRO at 1870 on the S&P 500. That is not what successful trading is about. It's not about being the hero. It's literally more about being the coward. It's more about being guarded. It's more about not trying to do something that's highly risky. Heroes, when we look at them in the comic books, they do things that are really risky, that puts their life in danger. As traders, we don't want to be the hero. We don't. The successful ones are never the hero. They're not the ones putting their capital in risky situations. They're not the ones putting the portfolio that they've worked long and hard for over the years through corporate America or through years of trading profits. The successful traders are not putting that portfolio money at risk. There's actually traders, though, out there that think, I got to double down. I can't take a loser on this, man. I believe in this stock. I'm going to take this thing back to the promised land. And they do that, and they lose it all. They lose it all, man. So here's what I'm trying to tell you here. Just because the market has, rallied 8% in October, it's up 215 points off of the late September lows. That doesn't mean you should have been low at the very lowest point of this market. I mean, does anybody know somebody who got long at 1870 on the S&P 500 when it touched it back on the 29th of September? I don't. If they were getting long at this point, they were probably making some bad moves along the way too. They were probably getting long here, and they were probably getting long again here, and then they were probably getting long here. The thing is that you can be right every once in a while catching a falling knife, okay, but you won't be consistently right catching a falling knife, particularly when it comes to the stock market, because the stock market will and can embarrass you big time. And if you don't put some proper risk mitigation steps at work, you're going to lose your capital. So I'm not trying to get 100% long here, and I don't look back and say, man, I should have been heavier to the long side. No, I don't think about that at all. I've been a couple of times like 70%, 60%. Right now, I am 50% long, and then 10% short on the market. So even right now, I'm starting to temper my expectations a little bit now. That doesn't mean that the market can't still keep going higher, and then I'll add more long positions as necessary. But you can't look back and say, man, I should have been more long than what I was, because you're trying to test the water with both feet. And I've already explained to you what happens when you do that, and you don't want to be that person. So trying to manage the risk in your portfolio does sometimes mean that the market's going to have these epic rallies where you can't be 110% long, because you've got to make sure that this rally is legit. I didn't really feel like this market had a sense of destiny to it, I guess. Maybe that's not the right word, but once it confirmed this double bottom here, that's when I started becoming much more comfortable with the market, because at any time I wasn't sure if this was going to establish a new trading range, somewhat like what we had seen back in February through August, back up in here. If we were going to establish something else like that, going from, this 1994, 1995 level all the way down to 1870. So it hadn't established that yet. Once we got this candle here and we established it back on the 8th of October, then I knew, okay, there's definitely something really good at work here. And then we keep breaking through these resistance levels, reclaiming certain moving averages and so forth, and the rest is history. So now we are overbought more than we have been in a long time. If I just go back looking at a couple of years here, this is your stochastics, and I don't base trading decisions on it, but it is a good way to know, okay, are we a lot more overbought than what we've been in recent days, weeks, or months? You could say, I mean, pretty much the closest thing to it is what we saw back in February of this year, and we ended up having a pretty good rally, not like what we've seen here of late, but we did have a pretty good rally that ultimately did have a little bit of selling that creeped in the month that followed. So November, I mean, there's a very good reason to believe that November could see some selling, maybe even finish in the red. But how do I do this? Okay, so before I get any further, I also want to talk about people trying to catch up with the market. They feel like they need to catch up. First of all, the market within a 5-day period went from, and I'm going to try and do the math in my head, so don't fault me if I'm not completely accurate. It went from 1871-ish up to, it went up to about 1986. So that's like a good 5% in 5 days. Okay, we haven't seen 5%, like that. Well, 2022 up to, yeah, not quite. That's about 3%, but we haven't seen anything like that since. What a lot of traders will try to do is they'll say, man, I only made, like 0.5 or 1% on this rally because I just wasn't sure if it was really the bottom yet. I need to make up that so I can match the gains of this current rally. Big mistake, guys, because if you couldn't get 5% off of this 5 days here, what makes you think that you're going to be able to make up that 5% here, say, over the last 4 days? You're not, unless you want to go extremely risky and put a lot of capital at risk. You're not going to do that. It's almost impossible unless you hit a big move in a particular stock that has a big news event. So if you can't make 5% when the market rallies 5% off of the lows like it did back in early October, what makes you think that you're going to be able to make that 5% off of a 1 or a 2 or even a 3% move? So, what I'm saying is, like, don't rule it out that you can't make some money. But if you're trying to structure your portfolio where you're getting really aggressive with your trades and extremely aggressive, trying to force the market to give you something that it's not willing to give you, you're setting yourself up for some major disasters. That's where people start getting into TVIX and UVXY and to the TNAs and the TZAs, because they feel like they've got to catch back up with the market but you were never really trying to chase after. You shouldn't have been trying to chase after the market in the first place. You should have just been playing the charts, playing the risk, and trying to play what the market's trying to tell you to do. So right now, like I said, I'm about 50% long, 10% short. I've got to be a little bit more narrow focused in what I'm willing to put up with in the portfolio at this point. Because yes, we could get an 80-point pullback. Let's say we could get a 60-point pullback and it pulls us, down to, like 2020s or so. The uptrend is really not affected still. I mean, the uptrend is still intact as long as it can bounce off of that level. It's really not been compromised, and we could still see like a big rush to all-time highs before the end of the year. That's still very possible. And it's very possible that you could get a significant few weeks of selling that causes you to lose some hard-earned gains. So I got a stock right now in my portfolio, MSI, and I bought this on the 22nd. So I think it was right here when it broke out. It was a beautiful breakout. The next day, it was okay. But then it had 2 days of selling, followed by a little bit of bounce yesterday, and then today it's just bleh. Okay, that's pretty much what it is, bleh. I'm not getting much out of this stock. And despite a pretty good rally in the market yesterday, I'm not getting what I'd probably expect out of this trade considering the market conditions and everything else. So for MSI, I'm down 0.1% in this trade right now. So it's not much, not hardly anything really. I got in at 70.36. It's trading at 70.25. If I can't get something out of this stock, and right now there's about an hour left in the trading session, I'm probably gonna have to dump this thing because I'm holding on to a stock that's not moving for the potential for some downside risk. So if it's not willing to move and the market's trying to show, especially with yesterday, hey, there's some buying going on in this market here and it doesn't want to take it, okay, this is a stock that I might just have to get rid of, okay? Because not only does it curb, the risk for me, or it gets rid of a stock that's just not doing much for me, but it also helps me to mitigate the long exposure in my portfolio also. So instead of being 50% long today, I'll be 40% long. Plus, I'll have a position where I'm 10% short in. So that's with MSI. Now you take a stock like DIS. I don't feel the need to sell this right now. I got into Disney. This is probably one of the longest held trades I've had all year. I got on this one on 10/19. So I'm going on 3 weeks with this one. And on 10/9, I got in at 105.88. So let's pull up 10/9 here. We got to find it. Okay. So we got in. It was breaking out of this, nice consolidation pattern here. We got in, since then it's just been riding up this 5-day moving average for me. And I've had no reason to sell it. Now, if it closes below the 5-day moving average, I'm probably going to be tempted to sell it at that point. But it's not doing that yet. It's trading at 104.85. I got in at 105.88. I'm up about 8.5%. What on that chart tells me, hey, yeah, I know the market's getting overbought right now, but Disney's holding up pretty good. Disney held up good, over this whole entire week. It's up 4 straight days. The market's had 2 days where it's finished down. Am I right on that? Yeah. 2 days where it's finished down. It's going for a 3rd day, or it's trying to finish down today. So it's holding up good. The buyers are continuing to go on, and there's probably some fundamental things going on with it. You got the Star Wars thing. If you thought Frozen was big for Disney company, wait until you see how big Star Wars is going to be. Disney focused on, or Frozen was focused on one generation for one side of the gender equation with females, and it was like a small group of young girls that loved Frozen, and you saw what it did for the company. Star Wars encompasses 3 generations of people that are infatuated with everything to do with Star Wars. They got Lego Star Wars. You go into Bed Bath & Beyond. I was in Bed Bath & Beyond yesterday, and they've got tons and tons of Star Wars stuff. I don't think there's a retail chain in America right now that's not trying to capitalize off of the Star Wars phenomenon. So this all goes back to Disney because they own the rights to it. And I think that's a lot of what you're seeing right now with Disney. Now they got earnings coming up next week. I'm not going to be holding them through earnings, unfortunately. But, if it doesn't make too big of a run, I may actually jump back into Disney because I do like it from a technical standpoint. So that's the difference between DIS and MSI. I have a better level of comfort. The stock's not causing me any reason to get rid of it. It continues to march higher. And then when you have an overbought market, it's not a bad thing in an overbought market to get a little bit short on a stock. But you got to find a stock that's really showing some bearish tendencies. And I found that with BBY. And with Best Buy, man, this stock can be an irritating stock to trade. I mean, you just look at it today. We were up well over, or the stock was up well over 1%. I was down, obviously, since I was shorting over 1%. Then it comes crashing down. Then it comes, rallying back up. Now it's coming back down. By the end of the day, maybe it's at break even. I don't know. But you can see here, really bearish pattern here. It's breaking through some support. If it can close where it's at or lower, that would be phenomenal. But in any case, though, it's broken a clear level of support. It's got a bearish pattern to it. I'm not looking, though, to get ultra long or ultra short on this market. I think there's a difference between adding a short position against a collection of long positions in a market that's still rising versus trying to step out in front of the trade and saying, I'm going to go TZA 100%. I'm not going to own any. I'm fire selling all of my long positions, and I'm going all short, thinking that the market's going to it's imminent that the market's going to short. No, I chose basically BBY because despite the market going up, BBY just keeps either consolidating or going long. So I felt like there was a less risk exposure to if the market opens up 20-30 points tomorrow. This stock is still probably going to be struggling. Maybe it probably would still go up against the backdrop of something like a 20-30 point rally, but I have a lot of long exposure that's going to negate those losses with gains. And then also BBY is just struggling altogether. So that's the kind of shorting that I'm doing in this market. I'm not looking to get like heavy short. I'm just looking to add a little bit of short exposure so that if we do have like a 10, 15, 20 point down day on the S&P 500, I do have some short exposure. Maybe I go ahead and cut a couple of positions out, like MSI. Maybe I cut out, a few other positions. I got Apple right now. Apple's doing great. Nothing wrong with this breakout here, the base that it's been in since the past few months. Following earnings, it gave me still a good entry price to get long on. So, but I want to hold on to those kinds of stocks, but then I want to sort of short the stocks, and not a lot of them. In this case, I only have one. The stocks that are really bearish, they're not showing much, but it gives me a little bit of exposure in case this market finally decides to pull back. So that's how I'm trading an overbought market. I've thrown a lot at you, but I tried to focus in on a few key points for you to think about. But if you have any questions, feel free to check out some of the offerings that SharePlanner has, namely the SharePlanner Splash Zone. That's sharePlanner.com/splash zone. If you have any questions about the service, you can feel free to email me at ryan@shareplanner.com. Yes, I do answer your emails. I'm the one that receives them. And I'd love to have you in the Splash Zone to start trading with a great community of traders. And I'm not the only great trader in there. There's plenty of great people who trade options, trades equities. Jump in there, man, and be part of one of the best trading communities on the web. And once again, that's shareplanner.com/splash zone. And look forward to having you there. Take care and God bless.